welcome everyone. This is Gulshan Saluja from Headstart Investor Circle, and I think today we welcome Kailash Nath from Chiratae Ventures and other participants on a session called "How to Spot a Great Deal." I think it's one of the most important sessions for being an angel investor, how to spot a great deal so that the returns that you get are maximized, right? So just to start with a bit about Headstart. So Headstart is basically a 15-year-old volunteer-led organization, and we basically help at grassroots levels for early stage startups. And through we have various initiatives that we have, like one is Headstart Investor Circle, another one is Headstart Hubs, Headstart Boosters, and also we have a great community of early stage startups. And we are present in more than 30 chapters in India. Apart from that, we have international chapters as well. So about today's speaker, we welcome Kailash Nath. He is a AVP from Chiratae Ventures, and he's one of the initial person who actually I have interacted. And one thing I want to tell about him is basically he gives a great detail about talking to startups. So I met him in one of the Headstart events at Indore, and he was so passionate about talking to startups. He spent a lot of time with startups, and I think that's one of the qualities of actually investors that go to details and talk about what they're doing and see how we can help them. Apart from that, he has done his MBA from Indian Institute of Management, Bangalore, and he has been part of National Institute of Technology, Karnataka. Yep. Welcome, Kailash, and over to you.
Yeah, thanks, Gulshan. Thank you for the very sweet introduction of yourself. Happy to be a part of this. Always great to come back to the Headstart community, and like you said, it's wonderful to talk to the participants, be part of the network that you're building, both in terms of angel investors, HNIs, family offices, and also, or more importantly, in fact, entrepreneurs. So it's always very heartening to be part of Saturday sessions and Headstart network. So I'll give a quick brief about how I'm approaching the session. So gives everyone a context on how I am taking everyone through on how to spot an investable opportunity, right? And I say great is a very subjective one. So I've decided to call this an investable opportunity, trying to make it as objective as possible in terms of finding opportunity in the startup environment. People say investing is an art. I believe that it's both a science as well as an art. There are a few things that you can build principles on, which can be repeatedly followed over years. And there are things which you learn over the years, right? It's something that you cannot teach people. Can be a borderline of science and art. But there are a lot of fundamental things that once you pick up, it can be systemized. There's a system that you can build around investing itself. Not just investing, but even building something as an entrepreneur, building something that lasts, right? A platform that lasts and makes what people call a dent in the universe. So I'm approaching this session from not only just an angel, as a investor, as a venture capital investor. And the reason I say this is a lot of early stage investments, fortunately or unfortunately, ends up finding its success through a validation of the next stage investor, right? For example, as an angel investor, you would want your portfolio companies to raise more capital, find more validation from the larger ecosystem, and ultimately give you a great exit, right? Like someone whom I follow in life told me once, a great buy is a great buy if it can, or a buy, basically, a buy decision can be a great buy if it becomes a great sell sometime down the line, right? So for that exit to come to you at a later point in time, you depend on a set of stakeholders who can provide you that exit, right? So being so if you as a listener to for this session are an angel investor, I'm offering you a perspective of what is the next stage stakeholder who gives you that exit, or can potentially give you that exit, would look for in an opportunity, and hence backtracking from there, what it means for you to think through or ask questions about events that will happen down the line for the portfolio, and hence decide what constitutes for you a great buy or a great investment at this point in time, right? So that's such a brief background that I wanted to give to you. I want to reintroduce myself. I head the seed investment for Chiratae Ventures. We are a India-born fund. We are a Desi venture capital fund, the largest Desi venture capital fund that there is in the country at this point in time. We manage a little more than $1 billion. Probably just share my screen and get started to give you a quick introduction. And maybe we'll take a set of questions. We have maybe 45, 50 minutes at this point in time. I want to wrap up my session in like 20 minutes and then maybe make it more of a dialogue than just a one-way presentation. Would love to take up any questions as we want to make it a conversation. So I'll try to wrap up my presentation in the next 20 minutes, and then we will maybe we'll have some questions from the participants, right? So I'm calling this a session which is more sharing our perspective, right, on how to spot investable opportunities, right? So just to take you through the journey that we have had. This is 16 years right now. So it's about 2006 when we started as a firm. We managed about 5 entities at this point in time, 5 funds. Invested in 125 companies, out of which some of the numbers are stale. I think it's to be updated, but 125 companies at this point in time, out of which 82 are active. We have about three IPOs which have come from our stable, 8 unicorns, 8 going to 10 in the next 5-6 months at this point in time. A great global advisory board behind us, a great set of founding team, an investment team that is driving our journey through years to come. We have been fortunate to be part of the growth story of some really solid market leaders at this point in time, right? Lenskart, FirstCry, Policy Bazaar, Flipkart. Most of you might have been users of offerings from these companies, but some of the emerging market leaders as well, in the form of Bounce, which is a leading EV manufacturer at this point in time, CureFit, which is now becoming a global platform for wellness and health for people around the world. Healthify Me, which is also a wellness platform for people to lose weight, etc. These are the companies which are the next decacons, as we call it. Companies which are chasing the $10 billion valuation, but more importantly, chasing the $1 billion revenues, which I think is a much more important metric to track for investors, because you're investing in opportunities which can potentially become much larger, and I think these sizes is what drives the valuation. So the focus now, I think, is turning inward and seeing how we can create something that can last years to come, rather than maybe a blip or a fad in the market, right? So this is a very brief about what we have done. We are very, very active at an early stage. We run what's called Sonic. Sonic is Sonic is my baby at the firm. It's our flagship seed initiative. We invest in seed companies, and within this program, between $0.5 to $2 million. We have made exceptions. We have invested as less as maybe 200 to 50K. We have invested as large as $2.3, $2.4 million as well. But typically our sweet spot being anywhere between $0.5 to maybe $1.5 million, where we have done pre-revenue as well as early revenue companies, right? We are building a playbook for what we call as very sustainable and a potentially successful seed investment at this point in time, trying to do a quick turnaround for opportunities that come to us. We provide as low as 48 hours of turnaround in our business diligence. The reason, because we have standardized the way we collect information, due diligence. We are creating playbooks for strong thesis-driven investment across sectors, and we also have ecosystem partners like Headstart who work closely with us, feeding us information about the market as well as opportunities that it is building as our pipeline. And we leverage that expert network that's building be around us to help us really build a platform that can continue to churn and create opportunities out of India, which can change the world, right? And we standardize most of our diligence process. Like I said, a lot of investing is science, so can be standardized. And there'll always be a small part of art which you cannot help, but at least the part of science which can be standardized is something that we always try to aim within Sonic as a platform, right? We have made about 30 investments out of Sonic in the last 2.5 years time. We are right now raising our fund 5, and out of this fund 5, we look to make at least for 35 to 40 investments in 35 investments at least in seed investments, another maybe 2022 Series A investments out of the Fund 5. So as you're building on to the launch of the Fund 5, we are also looking to build extremely precise thesis across multiple sectors within the startup ecosystem, right? So that's where our entire network of Sonic partners come to our help, and we leverage each other's network to build that intelligence, right? Most of you are, I'm guessing, are actively investing in early stage. So I won't take you through the entire financing ecosystem and how it works, but just so that to give you a framework, right? There are investors such as you who are looking at pre-seed or early seed investments. We typically come somewhere between the seed and the venture capital stage, where we look at investing in companies which have some kind of MVP, some early validation ready, looking to launch into the market as part of their journey. And then we look to back these companies, and they continue, right? And most of the angels also continue, given that some of these companies become potentially a great successful companies as they grow. Right? And then there are players like later stage venture capital firms, or mid to late stage private equity and buyout funds who come much later. But this is typically how we have our mental model for the investing ecosystem. So offering you what's a framework that we typically follow. Again, I won't go into details of how a VC or PE fund works. Most of you might be aware, but just to give you a sense, a VC fund is a pooled vehicle, a pooled capital vehicle, which has investment from the set of partners and the general partners who are the founding partners of the firm driving the investment journey, building intelligence sort of journey. And you also have investors who are limited partners who have faith in us, in our ability to provide them supernormal returns. And we from this as the investment team, the general partners investment team, out of this VC fund, invest in specific companies across sectors based on our thesis, which can then provide them supernormal returns, right? And most of the venture capital firms also approach investments with certain constraints, which allow or don't allow them to make such investments. Because I mean, there are multiple great business opportunities, but there are only very few venture capital investable opportunities, because there is a return expectation within a certain timeline, because we as a VC fund need to return back capital to our investors, and we have restrictions on how much amount we can invest in one particular company. And of course, we have certain reporting requirements in terms of compliance as well, flowing back into our investors, right? So a VC fund generally comes with these constraints, which is why we say no to a bunch of entrepreneurs, even though we feel they're doing something really fantastic and disruptive, because this just doesn't allow us to invest through this framework, which comes with so many restrictions, right? But more importantly, I want to offer to you as maybe my 2 cents on certain evaluation criteria that we follow as VC firms, so that you take that as a playbook and ask questions which are more forward-looking, but will give you a sense of whether you are spotting the right opportunity, which can potentially raise many more $1 million of capital from venture capital firms, which will come after you in the journey of the company, right? At an early stage, I'm talking as a seed and pre-series A investor, right? We look at the the single most important factor for us is a founding team and the team which is they are building around them. The question to ask is this the right team? Are they, of course, you do a basic check on them, saying they have the minimum basic reputation, they have the pedigree to run this company, etc. But more importantly, do they have the understanding on the kind of business they want to build? Do they have experience building great product? Do they have experience building a great team below them? Do they have the relevant skills in terms of understanding? Do they understand who are the stakeholders? Do they understand the fundamentals of what the client wants or the customer wants? And can they work backwards to build something that will satisfy the white space that they're targeting, right? So that's very, very important. I think almost 40 to 50% of the weightage is on the founding team that comes together to build what they want to build. Right. Another important question to ask is the addressable market. And the question here is, can this become potentially a very, very, very large market to go after, right? So fundamental question to ask is, what's the target group that you are, or TG that you are trying to target? Has this been identified very clearly? Is this some are there alternatives, sort of I'm just combining the second and third point here because they actually go hand in hand, but are there alternative solutions that the current user is using which needs to be changed, right? Is there, I mean, basically you're building empathy for the end user. What is that the end user wants, and is the founding team looking at solving that problem rather than just having a hammer in hand and viewing everything as a nail, right? That customer empathy or the client empathy is something that's very, very important. And that client empathy coupled with a large opportunity is what makes it very, very, very interesting for investors like us to go deeper in terms of engagement, right? Of course, we also build things like what is the competitive landscape, who else is doing what, how differentiated this company is, etc. But fundamentally, it all boils down to the understanding of the founding team and their ability to target a larger market than what is obvious, right? The best, like one of my mentors in life says, the best solutions in life are simple but not obvious. So something that's very simple built, something that's built in a very simple fashion, the ability of the founding team to simplify a particular solution which can be adopted in a very, very seamless manner, but it's not very obvious for the others who are competing with this company to build, right? That comes with insights, that comes with effort, that comes with clear understanding of what you're trying to build. That I think is super important for you to judge as an angel investor earlier in the day itself, right? You don't have to wait for validation from the market for you to get an answer of yes or no here. This, of course, comes with time, comes with practice, comes with having more conversations, and I'm sure most of you listening to me are well versed and well experienced in judging founding teams. But this is I'm offering you a framework which we follow at an early stage, right? And of course, the next question to think about is unit economics. Do you think this product will really make the kind of revenues, and is the founding team thinking through building a solution in a much more sustainable way? What is a means of acquiring a customer? Can you, I mean, is the price point really relevant for a particular target group? And can the company, if proceeding with this particular unit economics, really can sustain itself in terms of operation, etc.? So all those questions are there to ask. But I think the fundamental questions to ask is great team, great market, and a white space that is coming out very, very clearly in terms of insights. I think these three questions, if answered very clearly, can get you to a level where you can start going into details, right? Then you start asking questions like who is investing in this space, who are the kind of investors who will come as a follow-on, and what you can offer to the founder as an angel investor, and how can you accelerate the journey to greatness, right? So that those questions will come, but the fundamental questions for us are these 3 points, right? And exit options is something that, I mean, like I said, who are the next investors? Where is this company headed to? Will there be an acquisition opportunity 4 or 5 years down the line or 6 years down the line? Those are questions to ask, but those will follow. Those will follow as you come by. And this is something that you will see common across multiple early stage investors as they view opportunities for the investments, right? This is one question on valuation that I keep getting asked again and again across multiple people I hear, but I think that's something to, I mean, I want to clear airs, right? Valuation is actually very, very small part of the decision making of any investor. I mean, it's like this: you want to own a certain part of the pie, and you're willing to invest a particular part of your wealth into this company based on your confidence, and that's what determines valuation. There's no rocket science here. There are subjective things like what are your alternatives available, where else can you deploy your capital, and what is the risk that you can understand, etc. But all said and done, the valuation is driven by how much are you comfortable in taking investing, and how much would you expect as an ownership broadly, right? It involves negotiation. There's no hard-coded numbers here. People keep asking me, saying what MRR, hence what valuation. Look, these are things which people come together as consensus, right? A consensus cannot drive your decision making. Your decision making, I mean, your multiple collective decision making comes together as consensus, and sometimes it's just simple handshake between you and and the founders, right? As you go later stage, like looking at growth stage, venture capital or mid stage private equity, there are certain thumb rules that people take. For example, you are looking at what's the revenue multiple, what's the EBITDA multiple, and all that. But early stage, your bet is purely on the product, on the founder, the product they plan to build in terms of the market and the clarity in terms of how well do they understand the client, right? And definitely not the most important part of the investor's job. In fact, there's so many things to wonder and worry about at an early stage than just valuation. So that was my sort of 2 cents on valuation. To give it as much importance as it deserves, and not a lot. And this is something that I tell founders as well, because people take valuation a little more seriously. I think they should think about dilution more seriously than valuation. Valuation is just a number which you attach. It's like a person's name, right? What's in a name is like what's in a valuation. I'm not saying this is not something to be ignored completely, but give it as much importance as it deserves, right? And not too much. So just to take you through some approaches to startup valuation. Again, I won't go into too much of details here. There are just so many frameworks that you can follow. But most of this boils down to a bunch of assumptions that you make. You look at discounted cash flow models, which I don't think is completely irrelevant method for an early stage. There are folks who would try to do comparable methods, a bunch of other approaches. But I think there's something that has come out well for us, at least in terms of VC valuation method, and probably I'll go a little into that on how that is done. It's a valuation method where you assume a particular exit value for yourself, and you assume that there are at least 2 or 3 rounds of investment that the company will go through before giving an exit, and you assume certain dilution at each round, and you start working backwards to know how much you should own at this point in time to make sure that your returns make sense in the early stage, in the long term, right? And of course, there are multiple templates that are built by several people in the market, and so I won't sort of waste your time here. But this is something that is least, or if you take maybe 10 methods which make a bunch of assumptions, this probably makes least amount of assumptions and has things which are in your control than external control. And this is something that people I've seen as have used this as a thumb rule. Again, just a tool for you to arrive at a number, and not something that you go as fundamental principle, right? This is something that it's a great tool in the back end. Of course, it's all subjective. So it's subjective. It is when it's subjective, it is depends on how much risk you want to take. For example, a risk that a larger venture capital probably will be higher than, say, you as an angel investor, because you as angels are looking at investing your personal capital. Venture capital, of course, is a committed pool where there's a certain amount of leverage, and they're allowed to lose some capital in the hope that other investments make up for it. Maybe you, as an angel investor, you won't have that luxury. So it's always a bit of subjective call here. And it's also reliant on what you think will be the company's journey going forward. But that I think is the reason why you are investing in early stage. So I'm guessing that is a risk that you can tolerate. Right? So this is broadly a summary of VC valuation method that we follow. Just to give you a sense of, again, won't spend too much time here, but just to give you a sense of what are the key inputs we as investors see when we ask for a financial model is your revenue projections. But more important than numbers here to mention here is the kind of clarity that you would want to see in founders to see how structured are they in their approach to the customer, right? How well do they own the customer? How quickly they are building a pipeline? What is the sales cycle? How well do they understand the journey with the customer? And how long are they looking to last as a vendor to their customers? What is the variation of price across geographies that they're looking at? How will they vary? How will their journey change with years? And how well do they understand that part of the process, right? Even on structure of cost, you're looking at how well do they understand what do they need to build in their backend as a team, as resources, and if it's a company is building a complex hardware, how well do they understand the supply chain, the procurement process, their product packaging, what do they need to think through, and do they have clear understanding of what it means to put out a world-class product in the market, right? That cost structure clarity. And of course, how they are thinking through how much investment that they need right now, later, going forward, what are the kind of investors they want to tap into in terms of knocking their doors, what is the repayment structure in case they want to take debt, etc. So these are things that you would expect clarity from the founding team. So more than the number, it's about how they're approaching the business, and that I think gives a great clarity for you as an angel investor to see if the founding team is ready for an investment which comes with a lot of risk, but also provides you that shot at a great return, right? And some of the key metrics, and again, leaving you with some key metrics, which some of the venture capital firms at least look at an early stage, and hence you should probably start asking to your potential investors. It's what is their CAC, what is their customer acquisition cost, and how are they looking to reduce this with time, right? So this is probably one of the most important metrics here, because ultimately you want to sell high and buy low. So which means when you're talking about buying low, you're acquiring the buyer at a lower cost, right? So the founders thought process of how are they looking to lower CAC consistently and keep a higher margin for themselves, right? So basically your margin is a proxy of how much value your customer or client is giving to your product. So if you have a high gross margin product, it means the client values your offering much more than what he offers other alternatives. So that clarity is very important. And what is the lifetime value? I mean, how long can you serve this customer on an average, and how valuable is your offering to him during the entire journey of your service to the client, right? That clarity, that understanding of what a client can provide or bring to table, I think is very important. Of course, the cost structure we discussed in the previous slide as well, and break-even analysis is a tool which is a result of all this clarity. Your understanding of where do you break even as a founding team, what is the kind of scale that you need to achieve to justify your existence and sustain your operations for a long time to come. All the clarity that you can bring through across unit economics feeds into this and provides you a great template for you as an investor to judge or make a stronger decision making. Right, so these are some of the key metrics. Yeah, I think this is all I had. I said 20 minutes. I think I've taken 22 minutes, but really want to break here and see if there are any questions that I can help answering, and see if we can make this a dialogue.
Okay. Thank you, Kailash. So we are open for questions. So probably you can put your questions on the chat, and we'll take. So before a great presentation. Some things that are happening now, like what we have seen. Shark Tank is one of the things that is happening, like Barbershop by Shantanu Deshpande. So you're seeing that a lot of angels are actually have started building their own brands, right? So we have a lot of community members here who actually are running successful businesses, are part of various multi MNC companies, as well as are also founders, right? So any thoughts around like how to take steps or any toolkit where the angels can start building their brands, and the flow of deals can actually work out like opposite way, instead of we going into multiple places for getting good deals, founders coming to the angels that, okay, I want to get invested by this by this angel, right? So any thoughts on that?
Yeah. No, interesting question. I think that's something that you rightly said, Gulshan. I think a lot of angel investors who are founders right now are putting out content, providing their 2 cents on how they view certain events or trends happening in the ecosystem. I think that is helping a lot of founders, because when you start giving or sharing knowledge, I think you attract people who would want to take your. I mean, why do founders come to angel investors, right? I mean, capital is available. Capital is a commodity now. It's not just for capital. It's for your knowledge. It's for I mean, having a great angel on your cap table is like reading a great book, right? You are leveraging on their mistakes and their experience so that you don't repeat those mistakes again. So I think that is probably, I mean, being present is probably the most single important sort of a tool for you to put out your presence so that you attract better deal flow. But having said that, I think there are multiple angels who are out in the market investing, and they're always looking for like-minded investors to join them. I mean, I'm sure folks like Kunal Shah, Ramakant Sharma, etc., who invest in groups, right? Not just as single angels. They come together and invest because they believe in sharing opportunities and being there for founders. I think the other more important thing is to one, of course, if they are founders in a particular space, you naturally attract founders in that particular space itself. If you're a SaaS founder, you'll always, I mean, there are multiple SaaS founders who will reach out to you saying that, look, I'm looking to hire a team. Can you help me? Or I'm looking to understand the client base better. And I'm thinking of my GTM, and can you help me, etc. I think some of these conversations will lead to an investment opportunity. Like one of our portfolio members, for portfolio founders, told me once, is a relationship which leads to transaction, right? You build great relationships, and the transactions will automatically happen. People don't transact with people they can't trust. So the relationship, I think, once built through multiple means, I think can lead to opportunities where you start attracting great, start leading to a situation where you start attracting great opportunities. That I think this, I mean, it's, I'm just trying to put the horse ahead of the cart and not the other way around. That's so I think that's my sort of 2 cents to answer.
So I think we have a question from Atul. So the basic question is, how do you allocate it between the primary investment and follow-on investment? And typically, how many startups do you target to invest in? Hoping though all would turn into unicorns, but that's not the case. So larger the number of investments, we increase the probability of having unicorns in the portfolio. It's basically, the question is around like portfolio members and how many investments that the angels should do, probably on the ticket size as well. So probably you can throw some light on that.
Yeah. So the way a VC investor works in a much different way than angel investors, right? For example, an angel, I mean, it's not supposed to lose money, right? A VC firm can lose money. For example, the fundamental principle that drives our journey says if you make 10 investments, 7 of them will fail for sure, and or 6 might fail for sure. Maybe 2 of them will return capital or a fraction of the capital. Remaining 2 make up for all the losses we make, right? They are the blockbusters. But as an angel, I think I know everyone is trying to go this entire portfolio management way itself. But I think great angels are the ones who think every investment through as saying this is going to be the blockbuster, and that's how we should sort of approach. And I think these fundamental principles are shared with me. If you can ask these questions at every stage of every startup, I think you will enter an opportunity much more consciously and much more in a prepared manner than not, right? I mean, you cannot approach every investment saying this will become unicorn. I mean, they will. It won't. I mean, naturally. I mean, that's the natural law of average doesn't allow it to be. But there, at least, there will always be opportunities. Will go 4x, 5x. Won't go 20x, 25x. But I think it's okay to back companies which can be 4 or 5x. You can always have opportunities which you get very excited, which can return maybe 20x of your capital over maybe 3 or 4 years. But if you find opportunities which can return even 5 or 6x with great founders, great clarity, great insights, I think you should still go ahead and back them rather than just thinking about unicorn, right? But because high returns always come with high risks. So sometimes you risk manage your portfolio also. It's okay to have moderate returns with manageable risks. And more importantly, work with founders whom you can have complete trust in, whom you can give you a significant part of your savings as investment, and come back and say, look, they won't screw around, right? They will run the company in a way that is ethically right and morally right, and will build it in a way that's promised, right? So I think that's where the entire portfolio management sort of concept comes in for angels, in my opinion.
Okay, just a follow-up question on this. So basically, we know that when the angels want to actually exit, right? Mostly VCs invest in the later stage, and they buy out stakes from the early investors as well, right? So how do angels can help founders and basically breaking out conversation with good VCs, and probably that's one of the exit strategies, like instead of building relationship with like angels, how can they build relationship with angel VCs as well, right? So they have a relationship with you guys.
So there are multiple ways, I think, working with VCs too. If you're an angel who have significant amount of capital, right? I mean, this is because I've had these conversations with a few HNIs and family offices also. One way of getting exposure is, of course, you will build your own deal flow pipeline and would want to invest directly as well. Maybe you could also consider investing in micro VCs or VCs like us, who are looking at the seed stage, right? Because we give you that opportunity to invest through a portfolio of investments, right? You can get better exposure because we as firms have been around for the last 16 years in managing our portfolio. So that's an option that's available. And us, as we are the largest rupee capital investor, right? We have about $1 billion of assets under management. Close to 60% of that has come in rupee. So we have raised about $600 million in rupee so far. And most of the rupee investors, apart from the institutional investors, are domestic retail investors as well as the family offices. So that's an option that's coming out increasingly, saying, can I, as a HNI or an angel, invest in these funds? In addition to taking direct exposures also, right? That's one option. Second, I think a lot of, I mean, if as an investor, if you research some of the VCs well, you will see that there are certain pattern of investments that they make, certain kind of readiness of companies that they invest in, certain kind of sector that they invest in. Some of the partners within the firm have expertise in a particular area or stage. For example, there might be VCs who significantly add value in hiring. There might be VCs which are very product focused, and the partners look at assisting founders with strong product builds to build out strategy. There are companies which are the VCs which have a strong marketing support team, which works with the portfolio to build a very strong GTM strategy, right? So identify these VCs and engage with them. I mean, not in a very transactional way, saying, look, I have investments and they want to raise, but also, conversations which will help maybe in a very mutual manner, right? For example, as an angel, you might there might be ways for you to work with some of their portfolio companies, helping them and building a long-term relationship. I think some that outlook can build that mutual one-on-one sort of conversations, which can then result in a potentially a conversation where some of your own portfolio can become their future investees, or if not, maybe there might be companies in your portfolio which might not be doing well, but you would want to exit out at least with the capital return back, and some of the VC's portfolio company can do an acquisition or an acqui-hire. So that those conversations become possible in the medium to long term. But I think some of these intelligent reach outs or more focused, precise reach outs can build conversations that can result in long-term relationships. That's sort of my way of thinking of it.
Okay. So there's one question in the chat room from Abhishek Kumar. So basically, for early stage startup, what do you think the revenue they should have? Like, he's talking about the revenue at early stage. So any figure that you have mind, and probably you can give a example of Sonic, like how you invest in Sonic, right?
Yeah. So I think it varies from sector to sector. It varies from VC to VC. For example, some of us are comfortable investing at pre-revenue as well, and we have invested in some really interesting deep tech startups which are not yet in revenue. But there are companies in consumer tech where we found great themes, but we wanted a little more traction before we go forward. And there are investors in the ecosystem who say, look, pre-revenue nahi chalega. I mean, we want some early revenue so that we can judge how well you are tracking as a company in the market, right? So it really varies from what investor you're talking to. For example, let me take an example. A company called Lightbulb in our portfolio that I've had a chance to lead investment into, and they are building an emotion recognition technology for companies leveraging video as a conversation tool, right? This can be in customer research, can be in building a strong or building mental wellness as well as engagement platform. You can also look at content optimization for multiple companies which are building very precise content for their potential audience, right? So this company has 4 patents on the platform that they have built. They're looking at facial expressions, looking at eye tracking, looking at your voice modulation, looking at the emotions coming from various ways of you expressing yourself, right? And using that has an intent to suggest to the person who's your user, who's a presenter, who's either building the pitch or building the content distribution, right? And we loved what they're building. We loved how horizontal this platform can be and can touch multiple use cases, and we invested in them when they had a pipeline of a good $500,000, but they hadn't generated revenues. So some amazing, interesting, cutting edge tech that we have invested into, even though they didn't have revenues, versus say there are companies which we have invested in at a stage where they had at least $500,000 to a 750K sort of revenue ARR, right? Especially on the SaaS side. So it keeps varying across sectors, across use cases. Sometimes it also varies at the stage of investment. For example, at the beginning stage of a fund, maybe we have a little bit additional risk appetite to look at taking a much earlier bet rather than maybe at the second or third year of investment, where you would want to take a little bit of more of a Series A investment where the company is a little more established, right? Because you have to return. We only have 7 or 8 years of tenure to wait for our exits. So it's a function of a lot of things. So there's no sort of single principle. But I think, like I said, a conversation with the investors that you're talking to, I think will bring out their preference and bring out some nuances on what they are looking for.
Okay. How to evaluate different exit strategy from angel investor point of view? Are there mental models that can be used? So
Yeah.
basically, yeah.
Yeah. So again, see, ultimately, what are the only ways of exiting is one, of course, the company gets acquired, or the company goes public, or the company does a secondary buyout, right? Where a large investor comes and buys out your stake in a secondary transaction. Some of these take time, some of these can happen very quickly. But typically, as an angel investor, when you come in, it's wrong to expect the next round investor to give an exit, right? Because if you're investing at an angel stage, a seed investor will always invest primary capital and not secondary. For example, I, as a seed investor, if an angel comes to me and says, buy me out, I said, no, sorry, because I want all my capital in growth of the company, right? That's why I'm coming in. I'm coming in saying that the company will grow to X, Y stage in maybe next 3-4 years time. So at an early stage, a seed investor will not give an exit, very rarely, and unless it's a very large investor who will coming to you and saying that, look, this is a great play, and I want a larger pie of this. I generally don't invest at seed stage, but I just found the founder so awesome that I want to take 25% of the company, right? And that happens once in a blue moon, literally, right? Unless there's a case like that, you will not get an exit within maybe 4 or 5 years of your investment. So come in with an ideology that this is an asset class which will stay longer, which will take some time to give an exit. But having said that, you are entering into a company's journey and building something really meaningful for the world. So that's how I look at exits. But I think keep exploring. There's no sort of set method of a way a particular company will exit, right? It could be great acquisition. Probably you're playing the game for acquisition, or you're playing a game for a much larger investment. But it keeps varying with time, keeps varying with a particular company's journey. There's no set rule, is what I would say.
Okay. Let's take another question from the chat room. It's from Ravi Kumar Tiwari. So there's a lot of CCD, CCPS deals happening for early stage startups. What's your point of view on this? Equity or CCD for early stage startup?
Yeah. So I'm typically okay. See, as a VC investor, we typically invest in price rounds. We generally don't prefer debt. In the last 125 investments that we have made over 16 years, I don't think we have made more than 3 or 4 convertible debt investments as a first check. But at an angel stage, I understand, right? For example, you don't want to get into a conversation where you are negotiating equity right away, right? Because you would want the company to take the capital, run quickly, build something, fail quickly, or pivot to a model which will eventually find success. So maybe it's some of the founders also prefer taking safe notes, taking CCD notes, which don't waste the time of these two parties negotiating on a number, right? Sometimes you're just because you're taking a risk higher than what a follow-on investor would take, you would take a small discount for the next round, and you would you put a cap saying that, look, I need certain amount of ownership, so I'll put a cap at which my convertible debt will convert, which is perfectly okay. I mean, CCD actually makes sense at a angel investment. Unless you are very clear saying that this is how the company is going to progress, this is what's going to be the value inflection at every stage. Hence, I need a particular kind of ownership, and hence this should be the valuation. Unless you approach it with that clarity, right? For example, you have been as an angel an investor in maybe say 70, 80 companies in let's say a particular sector like SaaS itself. And you out of 70 investments, you made about 50 investments in SaaS only. You have seen companies growing through stages. You know how it works, and you know exactly what the company should be valued at this point in time because you know what are the step ups going forward. Unless there's that amount of clarity, try not pushing for a equity sort of a structure. It's okay to have CCD. Sometimes it's okay not to have a price round at an angel stage. But it's again, it's a eventual again, like I said, a lot of things in life don't have set rule. Even this doesn't have a set rule. It will emerge as a result of the conversation between you and the founding team. But just keep your mind open for all the structures.
Okay. So Nalini, and so can an angel investor invest with your VC fund? So she wants to be your LP. Like, I think you should.
Yeah. I'm glad. No, I'd love to. In fact, we are right now. We did the first close of our growth fund. So our growth fund was the first growth fund we have launched. This is it's entirely for our growth companies, right? We won't be making fresh investments or new investments out of this or a fresh portfolio company coming in from outside. There are companies in our portfolio like Lenskart, ForceCry, Bounce, especially companies which have gone a particular distance in their journey, significantly less risky than an early stage, and we are inviting retail investors also to be part of that fund, and we are actively subscribing investment to into that growth fund. We'll also be starting conversations on the venture fund too, venture fund 5, so the fifth fund for early stage. But we're actively soliciting presence of retail investors. Like I said, we are a Desi investor. We understand what it means to build Desi companies, and we would love to have Desi investors be our LPs, who will go with us the entire long journey of building great companies. So we are open. Would love to have this conversation. This will be a much more detailed conversation. So happy to take it offline as well.
Okay, great. So Srirang, how to build a great portfolio of startup investments as an angel investor, diversify across sectors, stages versus focus on select themes, possibly basically sector versus stage.
So a sector, don't diversify yourself too much because like when Charlie Munger and Warren Buffett says, I think your money should be where you understand, right? Don't invest in assets which you don't understand. So for example, you have been a consumer tech person all through your life. Don't diversify too much into deep tech or fintech, which comes with the regulation, which comes with certain, let's say, certain hurdles or certain challenges in taking off, right? Learn to play in your circle of competence. Learn to play at least till you understand the game very well, right? If you have enough capital to maybe throw away and help founders without expectation, that's a different case. But I'm guessing a lot of you are looking at this as a mainstream investment where you are generating enough returns to justify the risk, which means play in your safe zone, places. Founders whom you understand well, founders who you can trust well, spaces which you understand well, client bases which you know well, areas where you can add value as an angel investor, teams which you can augment with your experience and expertise. I play in that known circle of competence so that you can reduce your risk of known unknowns and unknown unknowns too. I think that's a very important principle to follow in life. But having said that, if you are investing as a community of investors or a platform of investors, you will always augment each other's skill, which means you select one investor who leads a particular diligence in a particular space, and you all agree that you will run with that diligence. So that's something that you can always agree upon. But having said that, if you are going as a lone wolf, invest in what you know very, very well.
So probably just a follow-up question on this, like investing individually versus investing with the community, right? What's your thought on that? Like just 1 minute. What are the advantages? Yep.
Yeah, I think again, pros and cons. So if you're investing as a community of investors or platform of investors, I think you get access to larger deal flow. You get access to think of it as a company where you have multiple shareholders on the board, right? You have multiple different perspectives. You have multiple different lessons that investors bring to table, their experience, etc. You can tap into people's brains, right? But it also means that because you're investing as a set of angels, maybe 10 or 15 people coming together, your share of the cap table or in terms of shareholding will be lesser, but it'll be safer. Hopefully, will be safer because there's crowdsourced wisdom coming together. So it always comes with pros and cons. But if you're new to the game of investing in private companies, it's sometimes I think it's good to leverage people's experience and approach as a group rather than taking that entire risk where you have potential to lose your capital. I think it's sometimes uh, maybe tap into the community's wisdom before you venture out yourself.
Okay, great. So Smita, she has a question like, while investing as an angel investor, whose advice should we take? CAs, lawyers, investment bankers, and also she
Fundamentally
wants to know.
your own gut feel, because
Okay,
if you lose capital, no one else will come to save you. So your own fundamental, I mean, your brain should be in your control. Your thesis should be tight enough so that you trust it completely. Investment bankers are only people. I mean, I'm not great respect to investment bankers because they understand the space well, but all said and done, they don't have skin in your game, right? Because it's your game of investing. So you should be aware of the risks. Sure, you can take advice from CAs or lawyers to understand the accounting and the legal frameworks involved in investing. But all said and done, when it comes to commercial decision making, it should be your own personal decision. And you should be in a position where things go wrong. You need not blame anyone else. Saying, "Bhai, आपने बताया था पैसे डाला यहाँ पे डूब गया." I mean, that should not happen. You should be your own decision maker. Some of the mental models you build with time, it takes effort. Like everything, it's like a marriage, right? It takes time and years to build a great relationship. So it's just like that. Your investing experience is a long journey, and this only comes with time. There'll be mistakes you make, but I think when you lose capital, you should not lose the lesson, like Warren Buffett says. But it's true for public markets, true for private markets, true for anything in life that, for that matter. But I think it should be your personal decision making, where you document every decision making process before you make the decision, and blame nobody else for the decisions that you make.
okay. So one more question from Sanjana. What do you believe should be the average investment size for an early angel, like who has just started investing and is a newbie and is experimenting? Like, can you put a number to that?
I don't think you can put a number to that, because it's like how much would you invest in stock market every month, right, or every year. It depends on how much capital you have that you can dispense. Think of early stage investments as how much capital are you willing to lose completely, right? Put that money into angel stage. I mean, that might sound funny, but what I'm saying is it's completely up to your comfort. Sometimes completely upon your comfort of the founding team that you're talking to. If you trust the founder very well, for example, it's my cousin brother, right? I hopefully trust him well, and hopefully he trusts me well, and I know what he's doing. Probably I will invest a little more than what I would invest in a completely different company, which probably strangers, but who have good credibility, but whom I don't know or don't have a strong relationship with. It keeps changing. I have seen people invest as low as a lakh to angels investing up to a crore or more. I've known angels cutting $1 million check because they have enough capital as an investment kitty in their bank accounts. It can be a very wide range. It's a function of so many things, and it's fundamentally it's sometimes function of what your gut is feeling. Right? You have seen a situation like this, so your gut feels that there's a great investment opportunity. Let's do it. Sometimes you'd want to write maybe 10% of your life savings, saying that I'm going to invest in this company, 10% of my life savings. Great big amount. You can't lose it completely, but you just inherently know that this will do well, and you go ahead with your gut decision.
Okay, great. So before we go to the last or probably last two questions, I just want to tell about more about the community that we are building here, right? So Headstart Investor Circle, basically it's a Headstart's initiative. So it's aimed to maximize the availability of the angel funds for a promising early stage startup. So we have a really great aim of educating the angel investors to invest in early stage startups, empower them, and also help them in creating a community where they can invest as a group, right?
Yeah,
And also learn a lot of things.
yeah,
So this is more about Headstart Investment Circle. We also help handhold a lot of investors and investment experience as well as provide the best possible information and updates to
yeah,
maximize the availability of early stage funds for the
Yeah.
startups.
Yeah.
And as we have already have a great group of early stage startups as well, right? So we also help startups and helping the marketing and a lot of other stuff as well, right? So we are working on the both the sides. We are helping investors getting confidence on the startups, as well as we are helping startups to go to market, as well as helping reach out to more and more investors. So yep, so Rupali is going to put a link on a community link, which it's basically a WhatsApp link. We have a Headstart Investment Circle WhatsApp group where you will find a lot of information that is already coming around on what's happening, what are the trends, and also more information about overall market trends. Yep. So if you are not part of Headstart Investor Circle WhatsApp group, probably that's one of the groups or WhatsApp that should be there on your WhatsApp community, right? Um, any last thoughts, Kailash? Probably
Mm.
for the early investors, because we have a lot
Mm.
of investors or angels who are just going to start their journey as angels, right?
Yeah.
So
Yeah.
any last advices or thoughts on that?
No, I think, like I said, it's an exciting journey. There's a thrill that this can give. It's like it's kind of like driving a F1 car, right? The speed thrills you. But I think fundamentally, again, going back to Charlie Munger and Warren Buffett's principles of investing, what is true for public markets also true here. Probably there's higher risk, but the fundamental more, principles of investing remain the same. Don't invest in what you don't understand, right? Don't have FOMO. FOMO is very bad. When you have fear of missing out and you invest in companies where you don't understand well, I think, like I said, you don't have anyone else to blame but yourself, right? So don't, I mean, learn something fundamental, even if it means you go and research a space completely, thoroughly. Um, do that before you come into a particular space and invest. So that's very, very important as an investor. That's true for VCs. In fact, we take so much time to build thesis on a particular space. We speak to all the companies building a particular solution before we decide to take a bet. That's how we do. I mean, if we are doing that as part of a pooled vehicle capital or a pooled committed pool of capital, you as an your investing, I mean, your investment, which is the result of your personal savings, should be even more even more conscious or cautious of investment that you make. So please understand what you're putting your money to. Second, uh, always invest in people you can trust well, right? Trust comes first, relationship comes first, transactions come later, right? Could be co-investments, could be future investments, could be even even getting acquisitions for your portfolio. I think it's conversations become much more fruitful when you have relationships, and you can't build a relationship at a point where you have transactions. It's very, very superficial. In fact, a lot of people, I mean, something that I've learned as part of my, I mean, most important that I've learned as my investment journey so far is people value relationships more than anything else, right? If I have a great relationship with the follow-on investor, I think this the forthcomingness, I don't know if there's a word like that, the ability of for them to listen to what I want to say or oblige to my request is much more than otherwise, right? So look to build great relationships with all stakeholders. Follow-on investors, founders, co-investors, or even investors who sometimes invest before you. Right? You might be investing at only Series A as an angel, but there might be investors who are investing in previous rounds. So have great relationships with them, understand them well. There'll be people whom you don't want to work with, but that's fine. Sometimes I think disagreement should not come in the way of working with each other. But I think the way to make great transactions is having great relationships, right? I mean, some of these take years to come through, and most importantly is have patience, because everyone is. I mean, the struggle of a founder is something that is understood, if I may use that word, right? We don't understand what it means to build a strong product which can last for years, right? Because a founder is always fighting fire, building a team, keeping the team alive, keeping the motivations alive, understand the client, getting the sales process through, coming back and redefining the product or reworking on the product, right? Even after making sale, you have to get the cash out of the client. That itself is a fight. especially if you're dealing with large enterprises. You're fundraising, you're constantly in conversation with multiple investors because some of the conversations can die at any time. Their conversations go to the investment committee of a investor and die there, right? So you never know till the cash hits your account. There are transactions which have been pulled out even after term sheet, even after multiple external diligence done, and there's some random clause which will make the investor decide not to go ahead with the transaction. So you can never take anything for granted. So a founder's life is super difficult. So appreciate that struggle and be patient with your founders. Of course, there will be things where there might be some unethical behavior. I mean, that's something that you should not put up with. For example, criminal offenses should not be something you should put up with. But struggle is something that you should always support your founders. So, one sort of humble sort of suggestion from my side to all the angels is, when you come into a cap table of a particular founder, always find ways to help them survive, help them grow, help them get to the next level of their value creation and valuation. If you can do that, I think your presence on the shareholding structure, on the cap table, will be far more respected than the capital that you bring in, because capital is commodity. Any large investor can bring capital, but they can't bring presence, which means they can't bring the ability to ride the journey of the founders. I think that is far more valuable than the capital or the dollar amount that you bring in. But that's sort of my limited understanding of the journey that I had so far. But this is my sort of humble offering.
Yep. So I think the last point what I got was that it's always important to have give priority to relationship building rather than before transactions. And we are running a short poll, so it's just a general request for everyone to be part of that poll. It will just take 30 seconds. Thank you, Kailash. I think we are really proud of Chiratae as well as you, because we have seen a lot of great founders coming out of Chiratae Fund, and being a Desi investor, I think we want you to be really successful and also play a really large role as far as the global stage is also concerned. And we really appreciate taking out time and educating our fellow community members at Headstart Investor Circle, and really happy to have you here. Yes. Yep. I think we are done for today.
Sure. Thank you.
And,
I hope everyone found the session useful, and happy to maybe connect separately as well. But really lovely to just keep coming back to Headstart community. I still remember I keep telling Gautam that the first, this is before I started my investment career. I switched to investment after an operating career for 4 years in a hospital group. And the first ever investment session that I attended was by Headstart community, the start of Saturdays. This was 2015. And I still remember whenever I attend or be a part of any Headstart session, that's one thing that always comes to mind. This is where it all started, right? It's a humble beginning. It was a humble beginning back then. It's always a great reminder of what you're building, and really kudos for the community, and would love to keep coming back.
Yep. Thank you, Kailash. Thank you, everyone, for joining today. And we'll be coming up with more sessions for you, for more education series for you. Thank you, everyone. Thank you, Kailash.
Thank you.
Yep.
Thank you, Uchan. Thank you.
Thank you. Have a nice day.